Hey, Kyle, I think you made some work for yourself.
Why? What happened?
So you remember our fantasy football discussion from last week about maybe
Of course,
doing
yeah.
this under-
Love it.
Yeah. Well, we got a ridiculous number of listeners
Really?
who reached out to me after the show. Yeah.
So what? We doing it?
And so
we doing it?
we've got a lot of people. They've got a lot of people who want to do fantasy football with us.
So what do you say? You got AJ, you in? Mauricio, you in? When you got to do fantasy football league?
I'll do it. If everybody else is doing it, I'm in.
F&A. Let's do it. Well, it'll be awesome. We'll do like trophies and like punishments for last place. It'll be great.
Okay. So I don't know how many people how many people can we have?
Let's do like 6. So we have like a 10-team league.
Okay, so 6 people. I'm guessing we're going to have a whole lot more interest than 6, so we may have to do a lottery. But anybody that's interested in doing fantasy football with the 4 of us, get in touch with me. Either send me an email, j@jscott.com, post a comment below this on YouTube, reach out to me on social, whatever you need to do. Get in touch with me, and we'll make this happen.
Welcome to Drunk Real Estate. Grab a drink and enjoy the show.
Hey there. Welcome to episode 55 of Drunk Real Estate. I am Kyle Wilson, Ashley Wilson's husband, and the gang's all together again. Mauricio, on location, some dark basement. Where are you, buddy?
Dude, I am in Wisconsin. Wisconsin Dells at a...
Is that like an all-inclusive wristband you got going on there?
It's a water park. It's another water park. Remember we talked about water parks about 4 or 5 episodes ago? So this is another one. It's outdoors here in Wisconsin, and it's halfway between Chicago, where I've been since July 4th, to the Wisconsin lakes, where we're spending a week up there at the cottage. So it's a little pit stop on the way up there.
I like how Kyle said you're in a dark basement, and you said Wisconsin, like basically the same thing.
Yeah, same thing.
Wisconsin. They serve alcohol at that place, or is it just a kiddie water park?
I felt guilty. I had to go to the water park with all these kids asking for beer or alcohol. I felt really good. But I'm drinking a Wisconsin classic, apparently. I don't know. New Glarus Spotted Cow.
Ooh.
A beautiful, I don't know what it is, but it's actually pretty good. It's a Wisconsin original. I figured, while in Wisconsin, drink a little Wisconsin beer.
That sounds like one of those craft beers that's like 9% alcohol.
I don't know about craft,
but Jay, how's it going, man?
It's going well. I'm having a good week. I'm excited. I'm not going to be here next week. I don't know if we're having a show next week. We're going to have to figure that out. I think 2 of us might be gone next week. Yep.
You're gone too, Mauricio? Jeez. All right.
Yeah. So you may do it without me. I'm going to be out of the country, but I'll be thinking about you guys if you have a show.
Maybe AJ and I will just do like a beatbox competition or something.
Oh, it's going to be epic.
Jay, what are you drinking tonight?
I'm excited to tell you what I'm drinking tonight. So my wife went to Costco today.
Oh, of course.
It gets better. It gets better. She went to Costco and she calls me up and she said, "Do we need any wine?" And I said, "If you find anything good, grab a couple bottles." And she said, "There's a sale. There's like some wine that was like on discontinued, and it's like a $30 bottle of wine, and people were taking cases of it. Like they were selling it for $13." And so I haven't opened it yet. I'm going to open it in just a second, but it's called Circumference from the Dry Creek Valley. $13. Apparently, if you go buy it from the vineyard, it's $45. You go to Total Wine, it's like $35. So
how many bottles did you get?
We got a couple, and if it's good, we're going to go back tomorrow, and hopefully there's some left. We'll get a case or 2.
Jeez, you saved $14. Good job, Jay.
More than that, it's like $17.
You're going to spend, you don't value your time very much. I mean, you have to go back and spend 45 minutes out of your day just to save $50 or something. What is your
I walked to Costco today. That's how close I live to Costco.
AJ, how's Ernie doing over there? He looks like he's back in his proper place.
Yep, he is. He's facing us again. Part of the discussion, aren't you, Ernie? So he's doing good. You're enjoying it. Ready to go, guys.
You got a clear plastic cup tonight, or are you going back to the red? Yep, sticking with it.
Clear plastic cup, showing off the goods.
Well, tonight I'm going back to. I'm going to give this one another try with Dad's hat. Give the shout out to the Pennsylvania. I figured I did enough product placement right here I didn't have to drink it tonight. So we could skip that tonight. So yeah, drinking a little bourbon. Should we roll with this?
Yeah. How was your vacation last week, by the way?
Awful. I hurt my back and I had to go home. Actually, so it wasn't that bad. Like sometimes it's nice to, like, I love my kids, but sometimes it's nice. Like I had like 3 days, like full days, just me and the dog. So
How long did Ashley have to think about whether she was going to go home with you or whether she was going to stay on vacation without you?
No, she loved it. She had her parents helping her too, so it wasn't like I was ditching her with just the 2 kids. So it was her and her parents. And 4th of July down at the beach, they loved it. Boardwalk, surfing lessons. Our kids are both surfers now, so hopefully they don't. Apparently that's expensive though. Hopefully they don't get too into it.
More expensive than the horse habit?
No, geez, yeah, I can't afford 2 expensive habits. I'll have to start drinking Costco wine. All right, let's get into this. So we had a bunch of economic releases the last couple of weeks, including PCE and that stupid jobs report. But the biggest news, it looks like 2 rate cuts are now back on the table, maybe. I don't know who predicted that, but maybe it rhymes with smile. So Jay, you nerd, why don't you update the other nerds and tell us what's been going on?
I'm on the fence on this wine. It's not bad. I think it needs to open up a little bit. I'm going to like this. Okay. What are we talking about? Did you say jobs? Let's talk about jobs. Let's see. What do I know about jobs? Okay. So if we're talking about jobs, and honestly, I didn't know exactly where we were going with this one, but I think that's a good place to start. So for the past, I guess, 2 years, we've been looking at a lot of data. And we've been trying to figure out where the economy is going based on all that data, GDP and inflation and retail sales and savings and credit and all those things. The problem is we can talk about whether the economy is good or bad or great or horrible or whatever. But unless we see the same trends with jobs, if the jobs don't reflect what we're seeing in the rest of the economy, it's a lot harder to make the case that what's happening is what we think is happening. In other words, like if jobs have to go along with our narrative on the economy for the whole narrative to make sense. And so for the past 2 years, jobs data has been consistently strong. Maybe you can find cracks in the data. Maybe you don't really believe the data, but if you believe the data, jobs have been pretty strong. There hasn't been much movement one way or another. But over the last couple months, it looks like we're starting to break trend. And things are moving in a softening sort of way.
What do you mean, Jay? It was 206,000 jobs were added last month. Robust job market, Jay. Explain that.
Well, we all know that that's going to be revised down. And that's only one data point. Let's look at some other data points. And again, we have to decide. And we've talked about this before. So we've seen a lot of kind of reverting to the mean for this economic data. And it's starting to look a lot like 2019 before the pandemic. But because it's so much worse than it was even a couple months ago, the question is like, is this a reason to be concerned? And same with jobs data. Like jobs data is no worse than it was in 2019, but it's a whole lot worse than it was 6 or 8 months ago. And so let's dig in a little bit. Number one, 4.1% unemployment. So unemployment came out last week. We ticked up from 4% to 4.1%.
Called it.
You called it. You did. Historically, it's actually pretty good. I mean, 4.1% is not a bad number. That's pretty much full employment. But we were at 3.4% early last year, so that's a huge increase. Over the last year, we've gone from 3.6% unemployment to 4.1%. We've gone from 6 million unemployed to 6.8 million unemployed. So that's nearly 1 million Americans who have lost their jobs in the last year. Again,
and your little SOM rule might kick in next month, Jay. I think another 4.1 probably would get us there, right?
So we are about. I was listening to John Chang, an economist, today. I think he's from Marcus and Millichap, and he was saying that, and I had looked at the numbers, but he did the math. He said that we need about 0.42%, 0.042% upwards for us to hit the SOM rule. And again, the SOM rule is basically if the lowest point in the last 12 months, if we exceed that by 0.5% in unemployment, that's a great indicator of a recession. And so basically what the numbers say is if next month we're at 4.2%, we've basically hit the SOM rule, and that's a trigger to believe that a recession could be coming. So anyway, so 4.1% unemployment, 6.8 million unemployed. Again, not bad compared to like 2019. Those are 2019 numbers, but a really bad trend from last year. Nationally, the number of job openings, the number of unemployed people is roughly in balance. That's a really good thing. We have about the same number of job openings as we have people looking for jobs. But the problem was at the height of the labor shortage, we were at 2 jobs for every person that was looking for a job, which was really strong in terms of just economic consideration. So this is the first time since the pandemic that we've seen jobs and job seekers in balance. We had millions of open jobs that we didn't have people for just a year or two ago. So the fact that we're back in balance, again, compared to 2019, that's a great thing to see. Compared to a year ago, it's not necessarily a good trend. I'm going to bring up a graphic here, but we have basically what we've seen is in every single state in the union, we have seen unemployment go up over the last year. So next thing to look at, and I'm going to bring up a graphic here, but basically the number of job openings in every single state in the union has increased over the last year. And so we're seeing a lot of job openings. And when I bring up this graphic,
figure it out, Jay. Jeez.
When I bring up this graphic, so here, hopefully you can see that. Basically, it shows a graph of the U.S. and each state, the number of job openings per unemployed person. And like I said, the average just 2 years ago, back in 2022, was we had 2 job openings for every person. Now it's about 1 job opening for every job seeker. But you'll notice that over here in California, this is probably the heart of the unemployment concern. Basically, in California, we have about 0.6 job openings for every job seeker. As of right now, pre-pandemic, that was 1-to-1, which it was in balance. It was great. So basically what we have is California is leading the charge on unemployment. Unemployment's over 5% right now. And much of that is due to what's going on in the Bay Area. And so the Bay Area is the Northern California region where a lot of the tech is centered. And so what we've seen is over the last just 6 months, so the first half of 2024, the tech sector has lost 100,000 jobs. Now, again, not horrendous compared to the last couple years. We lost, I think it was 160,000 jobs last year, 260,000 jobs in 2022. But the trend continues. If we stay on trend, this will be over 200,000 jobs lost in the Bay Area tech in the last year, and that's pretty scary, especially considering.
But it's down 40% since May. So the job cuts that we saw are down substantially from where they were at in technology.
Absolutely. And here's the other thing. I mean, I've talked about this before, that it's not uncommon when the economy starts to soften for large companies to do layoffs, even if they don't need to save money, even if they don't need austerity. They do layoffs because it's an opportunity for them to lay off. They can't really do it during good economic times because it signals bad things to their investors. So they wait until the market starts to soften. They do big layoffs. And again, it doesn't necessarily mean bad things. But what we're seeing right now in the tech world is that a lot of small companies are doing layoffs. And that's a whole lot more concerning. Tech often leads other industries when it comes to layoffs. And the fact that California is struggling right now in that department is somewhat concerning.
And that's driven by private equity mostly. The money's, all these startups that are cash flow short, they're not getting second, third, fourth rounds. They're stopping. So that free money is gone. So these tech companies that survive on investor money for long times, they run negative for long times. Once interest rates went up, once we started to see a real turning point in capital in the markets, those companies, investors stopped funding again. They just started picking the best ones and closing off all the other ones and shutting those down.
Yeah, we've talked a lot on this show and personally between the four of us about just the fact that venture capital has dried up over the last couple of years. And so investment into tech companies has slowed down. But one thing we don't talk about a lot is that it's not just equity that goes into tech startups. There's also this thing called venture debt, which is like real estate debt. There are banks and lenders out there and private equity firms that lend money to these tech startups, and their interest rates are related to other interest rates. And the fact that we have a federal funds rate at 5% and a 10-year treasury at 4.5% and other interest rates really high means that these tech companies that don't even want investors, they just want to borrow money, have really high borrowing costs. And so that's hurting these tech companies as well. And I think we all suspected that generally in the venture capital world, the venture debt world, companies come back to the well every 2.5, 3 years for new investment, new funding. And we're now going on 3 years since venture capital is completely dried up. We were back in 2021 when things started to completely dry up. And so a lot of these companies, as you said, AJ, are facing a need for additional capital, and they're hitting the end of their runway, and that capital is just not there. And so I think we're going to see a lot of good companies that in normal times would have done just fine. They would have succeeded, or they would have at least stuck around, that are going to be shutting their doors. And there's a lot of employees that are going to be losing their jobs.
Can I do my weekly jobs numbers rant?
Go for it.
So whenever they release the last month's jobs, they also do their revisions of the previous months. And guess what the previous 2 months revisions were?
30,000.
Each of them had more than 50,000 less than the original reports. So these robust jobs numbers. So the Wall Street Journal, whenever it gets released, job market's robust. Well, take 50,000 off that. It's not as robust. Not only that, so we had 206,000 jobs gained that last month. You know how many of them were government and healthcare? 150,000 of the 206,000. Do you know what I touched briefly on this birth-death ratio where they just estimate how many companies were created and they adjust it? Well, they adjusted it up again based on this birth-death ratio. So they thought more companies were created than were folded. And they added 59,000 jobs for that as well. So my math ain't too good, but it's almost zero if you take away all these like random additions and government spending. Like it's zero. They're not adding any jobs.
That's why the best, I think, indicator is normally, and it shows in these numbers, and this is the thing that's troubling to me. Tech is always the first, then they plateau, always, right? It's just like Jay said, there's a whole bunch of reasons for it, reasons why. They're kind of, okay, that, and then you see how far the contractions will go. And right now, we've had a 1,674% increase in construction company layoffs. So the layoffs announced from May are up 1,674%. That means people are stopped building America. They're not, we're construction companies just mass layoff. The projects in their pipeline have run out where the capital and money was coming in. Now they're forward projecting. They see the summer. They're doing their summer projects. They're wrapping up some of them, and they're trying to look at their pipeline through the off season, everything else. They're saying it's not there. The money's dried up, and they're all laying off people through the summer that they don't need. They're just short. They're short jobs. They're short everything. And so those layoffs are really picking up because they can see their pipelines empty. And right now they know the jobs in hand that have been executed over the summer months, and there's just no demand for it. And when you see the construction companies start to lay people off, that is usually, that is like bread and butter for economic progress. When those people are hiring, because you're building, that means businesses are reinvesting. That means you have people doing startups, everything else. And so that huge spike is a big indicator for me.
Yeah, it's interesting that in general, it takes about 18 to 24 months to build, and I'm coming from the multifamily side of things, but I'm sure it's very similar in other commercial asset classes. It takes about 18 to 24 months to build stuff. And housing starts were the highest they've ever been about a year ago. Basically, we knew that there was going to be a ton of inventory coming online this year, which means that there was a ton of construction taking place over the last 12 to 18 months. At the same time, we knew that housing starts basically were going to dry up this year, meaning nothing new is going to get started this year and nothing new is going to come online in the next year or two. I don't know if we thought enough about or discussed enough about the fact that that means that all of these construction jobs that have been booming for the last year or two, as you said, AJ, are basically going away. And we're starting to see housing permits pick up, but we're not seeing housing starts pick up. It can take 6 to 12 months from permits picking up to actually breaking ground, which means we could see 6 to 12 months of really struggling construction numbers in terms of employment, in terms of income and profits. And that's a big part of the economy. And so I wouldn't be surprised if this is the start of an economic softening. That could play an outsized role simply because a year or two ago, nobody even thought about it, but a year or two ago, people stopped pulling permits for new construction.
Yeah, I mean, by the way, what I'm hearing, which makes total sense, is there at the end of the day, there's just lack of money or lack of capital, for lack of a better word. I mean, investors aren't investing. Banks are in a tight spot. They're having issues, obviously, with multifamilies having issues. We talked about Silicon Valley Bank when it happened. Man, it's been almost a year ago now. But like, they're not getting the deposits from a lot of these tech companies because they just don't have the money. And it's just like, if you look at the M2 money supply, it's just the liquidity has been starting to pull out of the system, and it's not really gotten back into the system. And so when you don't have money for the technology companies to continue operating their businesses, multifamilies obviously having issues and they're not being able to get additional liquidity. Banks are shoring up their liquidity because they're trying to shore up their balance sheet because they're all kind of trouble. There's just not that much money sloshing around. So the velocity of money is just not moving around. And that creates a lot of problems, which I think is, with a lag, you talk about 18, 24 months, there's also an 18, 24 lag on sort of this liquidity drain. So it takes a little bit of time to show up in the economy. And I think you're just starting to see that.
And just to put a finer point on that, I'm not so sure that the issue is that the money is not there. The money's just not being spent. And this actually brings up another interesting point. I mean, if you look in the venture capital world, I've heard there's somewhere between $200 and $300 billion of money that's ready to be deployed, dry powder on the sidelines. But the venture capital operators, the fund operators, they don't want to deploy that capital because they're really concerned about what's going on in the market. So they're private investors, people like us who are happy to invest, but nobody's actually ready to move that money into deals. And I kind of wonder if we're seeing the same issue. I think if the issue is being compounded, again, I'll talk about the multifamily side, but probably similar in AJ's world and other commercial asset classes. The fact that there's so few transactions and so many transactions result in renovation. We buy apartment complexes. I imagine AJ buys self-storage complexes. And when you buy them, the first thing you do is you spend $500,000 or $1 million or $5 million on CapEx, on renovation costs. And that fuels the construction industry. But what we've seen over the last year or two is that we've seen very little transaction volume in commercial real estate. Very few properties are changing hands. And if properties aren't changing hands, that means people aren't buying these things and spending a lot of money on CapEx and hiring construction companies and doing renovations. And just the fact that transaction volume has slowed is probably having a huge impact, or starting to have a huge impact, on construction as well.
But having money on the sideline, I mean, that is part of the problem. I mean, having money in people's bank accounts, with government bonds, and they're just sitting there, it just doesn't create any velocity, any movement of that money. That money needs to be moved from their, 10-year bond that they have, the whatever treasuries they have. It needs to go into something like real estate, so that they can now use that money to do the renovations, to hire construction workers, to get jobs, to get employment. And you need that money moving. And if it's just sitting there on somebody's bank account or in somebody's government bond, that's creating part of the problem, because it needs to get moving, and it's just sitting there. Yeah,
it's a chicken and egg problem. Like, when the money doesn't get spent until there's projects to spend it on, and the projects to spend it on don't get purchased until the money's ready to be spent.
There's also still a lot of fear, as you guys know. I mean, I see it on the syndication side. I mean, it's still difficult to raise capital because there are people out there who have the 100 grand, 200 grand, 300 grand. They're scared to put it to work because they don't know what's going to happen in the next 12 to 18 months. And it's tough to get to pry investors from their hard-earned cash to fund these projects, even if you wanted to.
So we touched on jobs. What about inflation? Would PCE come out there too, Jay? So what's that telling us?
So PCE came in low, and basically all signs are, and we've talked about this 2 weeks ago. I think we did a whole deep dive on inflation. So anybody that missed our episode 2 weeks ago, but the data that we've seen in the last 2 weeks is along the same lines. We'll see CPI next week. I think it comes out next Tuesday or Wednesday, and that'll give us some indication on whether this slowing that we've seen in inflation is an anomaly or a trend. And it's starting to feel like it's a trend. I mean, it used to be, for the last 2 years, what we've seen is we'd see one piece of data that showed inflation slowing, then another piece that was showing it ticking up, and CPI was different than PCE, and core was different than non-core. But these days, over the last couple months, every indicator has indicated that we are slowing on inflation. Retail sales is still slowing, and consumer confidence is down, and it's all the actual inflation numbers are down. So I think it's premature to declare a recession or a softening. But if I had to make a guess, I think we are in the early stages of what will eventually be a recession, and I wouldn't be surprised if NBER, National Bureau of Economic Research, these are the people that make the decision on if we're in a recession or not, and they typically do it in the future or in hindsight. I wouldn't be surprised if they look back in 6 months, 12 months, 24 months, and they say this summer was the start of whatever we're about to encounter.
Can I throw some numbers at you guys? GDP 2.1, unemployment rate 4.0, core PCE inflation 2.6. What numbers are those?
Sounds like about a year ago.
No, those are the predictions. Those are the predictions that the Fed members in March made for what we're going to finish the year at. They were going to finish at real GDP change 2.1, unemployment rate 4.0, core PCE inflation at 2.6. That's what they said. There was going to be 3 rate cuts over the course of the year, and those 3 rate cuts were going to lead to end of the year statistics. So let's look at where we are right now with 0 rate cuts. Right now, our last GDP came in lower than 2.1, 1.4. Our unemployment rate, higher than what they had. We're now at 4.1. They said 4.0 by the end of the year. Core PCE inflation, 2.6, currently 2.6. So we've already hit our target inflation for what they targeted for the end of the year, for December. We've already hit that, and our unemployment is higher, and our GDP is lower than what they wanted. What are we doing here? How are we not? That was with 3 rate cuts. That's what they wanted to hit. And they still are saying, oh, we're waiting for more data. We're waiting to see further softening. They thought 3 rate cuts was going to get us to 2.6. We're already there. What are we doing?
Well, here's the crazy thing. Headline came out 2 days ago. Citibank, basically one of their senior economists, has come out and said that he thinks that there is a chance that we could see 8 rate cuts over the next 12 months. First one coming in September, and then for the next 8 meetings after that. He believes that we are long overdue for these cuts to start, that we've waited too long, and we're potentially not going to be able to catch up easily, even by cutting quickly, and literally thinks we could see 8 rate cuts over the next 12 months. So that's probably the most aggressive forecast I've seen from any serious economist, but this is Citibank. So,
well, Powell's given speeches to Congress today. So today he kind of threw up a nothing burger today. So I assume tomorrow is not going to be any different. He just towed the line that, we need to see more sustained progress towards 2%. So
yeah, he did indicate that things are getting closer. He's acknowledged that we're slowing.
Agreed, but at the same time, he's basically took July off the table. Some people were thinking, maybe with all this data, they were looking for him to say something that July's on the table. He took July off the table. But even with that, like the market's now 70% that we have a cut in September, and it's like less than 4% that we see no cuts at all this year. So like to me, so that's and it's calling for 2% is the most likely, or two rate cuts that are the most likely scenario of happening. But like to me, like it's almost like they're trying. It's almost like they're just like, okay, we've already assumed there's going to be a recession. Let's just keep this high so we can drop it further, and so we have a bigger effect. Like that's the only explanation I can get right now, because it just doesn't make sense to me.
So I've thrown up on the screen here, I think is really interesting. So the next two Fed meetings, there's one in July, one in September, then November. November is after the election. The one in July, according to this chart that I have up on the screen for anybody that's watching, basically the market is predicting a little over 95% chance that the Fed's not going to do anything in July. And I think that's probably reasonable. We're about 3 weeks away from that meeting, and it doesn't look like there's any reason to believe anything's going to happen. But you go out to this very next meeting, the September meeting, and we go to nearly 74% chance of at least one rate cut. So 70% chance, according to the market, of a single rate cut or a quarter point rate cut, and a little over 3% chance of a half point rate cut. So basically between July and September, there are a lot of people out there who agree with my thesis that what we're seeing is not just an anomaly, but it's a trend. And they believe that between now and September, 2 months from now, that there's going to be enough data out there that the Fed is going to start cutting. So I think that that's pretty telling that I'm not alone in my belief that what we're seeing is possibly a very bad negative trend.
You know what the worst indicator is? Have you heard of the Rick's Cabaret recession indicator? So I heard that on the All In podcast. So apparently, if you go back to the previous few recessions, and so Rick's Cabaret, which is a adult entertainment establishment, it's a franchise across the country. And if you look at when their stock tanks versus when a recession happens, it lines up. So if you go to so their stock is RCI Hospitality Holdings, and if you look, it's fallen off a cliff. So there you go. Like if there was ever an indicator that a recession is about to happen, it's the Rick's Cabaret Index.
Any idea why that is?
I can't wait for you to answer this.
That's got to. Well, you're going to answer. You're really asking, because I mean, I think it's pretty obvious. I mean, those are pretty discretionary funds that people have to go to those. I don't know, Kyle, is that right? The discretion, is that what you use when you go to these things? Your discretionary funds?
Well, I don't go. My wife goes. But she spends a lot of discretionary. But you're right. When times are tough, she doesn't go very often. So it's
or when she does go, she only gets two or three dances instead of the 5 or 6 she usually gets.
Probably, yeah. And he only gets 2 girls instead of 4. Yeah.
But the interesting thing, I mean, I guess where my brain went was alcohol tends to spike during recessions. People kind of give into their vices; they drown their sorrows, and I guess I just assumed that strip clubs would be along the same lines, but maybe not.
They must drink at home. It's instead of going to bars and establishments, they go and they pick up the fifth and they bring it home and drink it from a paper bag.
Save their dollar bills.
All right. Any other comments, AJ, Mauricio, or should we move on to our next segment here?
We can move on. I mean, I think I'll just wrap it up by kind of confirming that I do think that I do have the explanation you have, Kyle, which is the main tool that the Fed has when a recession does hit and when the what hits the fan is to cut rates. And so the higher the rates are, it gives them more room to cut when that happens. And if there's no reason to cut at this point, because things are, inflation's starting to come down, everything's kind of getting there without having to cut any rates, why not wait to see if we can hang on for a little bit?
Who knows? We will see when that recession hits, because it's kind of becoming one of those, a matter of when, not if. But anyway, other stuff going on in the world, hurricane Hurricane Beryl made its way across the country. Harsh reminder that weather events are happening more frequently and leading to millions and millions of dollars in property losses. So with that in mind, we thought it'd be a good time to revisit an earlier discussion about property insurance because it has definitely not gotten better since. So AJ, what's the current state of the insurance market at the moment?
So one of my favorite topics, insurance. The insurance, if you are in real estate, you have noticed how expensive it's gotten and how wildly almost out of control it's gotten. And this has been over the last 4 or 5 years that we've seen really an acceleration of insurance. Now, one of the things that people draw to is that, oh, it's because we're having so much bigger of storms and natural disasters, right? That's driving. And that's not necessarily true. In fact, if you look at overall, which I've got some stuff up here show you, that's a little point in a very big pie. And we're going to walk through why this escalation. First of all, I guess we'll show you how much they've increased. Which, when you look at the rate of increase from these, when you look at how much insurances costs have increased, this right here, we're showing multifamily, and you see how it was pretty, flat, obviously through 2008. But so basically it shows that, in 2011, it was $300 a unit. Today, it's almost 500. Well, excuse me. By 2021, it was almost 550. Now, prior to 2011, if you go back all the way to 2004, it was still right about $300 a unit. Now, can you see this chart that shows the average multifamily insurance cost and the cost of natural disasters? So basically it shows that, in 2011, it was $300 a unit. Today, it's almost 500. Well, excuse me. By 2021, it was almost 550. Now, prior to 2011, if you go back all the way to 2004, it was still right about $300 a unit. Now, can you see this chart that shows the average multifamily insurance cost and the cost of natural disasters?
I mean, I can. Jay probably can't. Mauricio, I don't know. He's a little younger than Jay.
Hopefully, our editor can expand that for us.
So basically, it shows this correlation. Now, the interesting thing is that when you look at overall, like natural disasters, and especially the overall power of them, because it's so easy just to say, oh, they're having more, whatnot. Actually, natural disasters have really not, specifically hurricanes, because this is a big driver of it, gotten much stronger. That hasn't really happened since the 1950s. And you can see the velocity here in energy of cyclones by NOAA. And in fact, when you look at it, the overall impact from natural disasters, including like death toll and everything, is down astronomically. So then people go, then how in the world, when we are looking at this information and we can see the amount that it's costing, insurance costs going up, why is that happening? Why do we see, like when they show natural disasters effects and how it's just going straight out? Well, it's a combination of a few things. First of all, the biggest thing is we have moved into areas that are not nearly, that are way more close to areas where you can get fire. We've moved into areas where we wouldn't have gone before. So natural disasters that are common, reoccurring things are affecting us more because we live in them more. But also, the big thing is cost. So the cost to build has skyrocketed. So when we look at the cost of natural disasters, we're talking about the cost to replace what happened, right? The effect of it. Well, as we've moved into mountains, on shores, reinforced things, built more and more, the explosion of people moving into hurricane country, which over the last, talking from 1950 to today has been astronomical. The population that has moved into hurricane country that migration has been so incredible. The compounding effect of the cost of those things is less to do in association with the storms and the hurricanes being bigger and badder, because they're really not. It is everything to do with the amount of people that costs to build there and the replacement of it. So in California, people have moved to the hills where they don't do fire control and everything burns down. And you have whole entire neighborhoods and communities that are wiped out, but those neighborhoods and communities weren't there literally 10 years prior. Why? Because they would always get wiped out by fire. So people wouldn't go there, right? This is a reoccurring theme that is not only not stopping, it's increasing. And we see this everywhere from the way that we handle natural disasters. So although when you look at it, the actual impact, meaning lives lost, everything else, is so much of a, it's like, it's insane to think that if you go back 80, 90 years ago, we were losing 500,000 people to today. It's literally like nothing. It's so insignificant. Even though in that time, our population has tripled. And when you look at then the cost of it, what happens with these insurance companies, they have to insure by law certain amount of people, certain areas. You have to buy insurance, you have to get reinsurance. And so you have a concentration of people, assets, and cost in these areas.
Well, and the government subsidizes flood insurance too, right? So like basically the government allows, but they're a last resort insurance. So like if an insurance company doesn't want to do flood insurance in an area, then the government will step in and insure that. They basically make sure that every property is insurable for flood insurance.
So that can happen. The cost at which it happens, though, the qualifications and everything else, that doesn't mean everybody gets it. And even if it does, even if they are insured, that still comes in as a last resort. The claims are still there. So what pool you're hitting in, okay, the government or the private, they're still concentrated. So where before what we saw was in 1990, the effect of a hurricane going through Florida on an insurance company compared to just 20 years later, the cost have tripled, but the people have tripled. So you have 3 times the amount of claims that one storm is hitting. The concentration of the negative downside has become astronomical. Everybody's moved to the south. They moved to Florida. They're moving to Texas, right? So all of a sudden, these events, they're hitting a mass concentration of people in areas in a time when building costs and everything has become so expensive. What has happened is as we went through, particularly we've been booming, we've been building, and over the last 5 years, as these great migrations have happened, the cost to build has soared. So what we've seen with inflation, if your building costs today versus what it was even just 7 years ago, right? It's double. So all of a sudden, when you look at that, these insurance companies, you have population in a 10-year period of time in areas like Florida, Texas, that have just exploded. The costs have doubled. And as those hurricanes come in, they're taking losses and they're trying to keep up with both population increase, property values, right? And then also the losses from natural disasters. These 3 things have a compounding effect on insurance, and it just propels those claims upward. So the losses that they take on are astronomical, and they're huge. In fact, a lot of insurance companies, they have done everything but pull out of the states. They're like, we can't even run profitable businesses. Now, property and casualty runs a margin about 16%, right? Health insurance, they don't make freaking money. They have on average 3% profit margin. That's what the health insurance companies run. Property casualty, they have a bigger margin, but they have way bigger hits. So when those guys get hit by a hurricane that goes through Florida, right? You know, it's literally taken some companies bankrupt. They went out of business.
So that's crazy. I want to reiterate that. I didn't know that number, but 16% margins, and I don't know if those are gross margins or operating margins, but in general, I mean, if their margins are about 16%, that generally means that they could reduce prices, costs of premiums by somewhere around 16% before they would be losing money. Which tells me that all of the people that assume that insurance companies are getting rich and ripping us off, maybe that's true to some extent. I don't know how much money they're making, but even if we literally socialized insurance, handed it to the government and said, run this nonprofit, as a nonprofit, our premiums on average would come down somewhere around 16%.
There's no scenario where the government took over that your premiums would go down.
I'm just pointing out.
Well, they've already, as I said, they already took over flood insurance, though. Like they already have a flood insurance program. But I also was reading that it's now 18. It's up to 18. It used to only be like 4 or 5, but 18 of the states that insurance companies, their ratios, they actually pay out more than the money they take in. Like it's like a crazy amount in 2023.
And how they offset this is the insurance company have something we call float. So insurance company, where they make their money, it is not on your premium dollars. They don't make money off your premium dollars. I mean, health insurance, they literally lose money more often than they ever make it. It is just a swapping of spit, as we call it, razor thin margins. Where they make their money is they have what is called float. Float is the capital that is dictated by law and by the government that they have to insure the premium holders they have. That float is sitting in the markets. It is in property, it is in stocks, it's in assets. So
probably a lot of it's in treasuries right now.
Probably. When markets go up, those companies, their balance sheet gets big. That's not off your premium, though. Does that make sense? That's not your margin. So what happens is when they take catastrophic losses, their float has to come in to cover it. But if you have a market that's gone up, like it has in the last 10 years, your balance sheet just exploded, even though you didn't make, it's not because you're charging people more. So these are the two sides of insurance that you have to realize. When you see how wealthy insurance companies are, it's their float, it's not what they're making off premiums. Even if they cut your premium down by 10%, what would happen is they'd have to make it up anyways on the losses because it's mandated by law. They can't not do it, right? You want that change, you got to change the law. It is swapping of spit when it comes to premium. Their float, on the other hand, though, if markets go up, they make a ton of money. If it goes down, they don't. And this is how Warren Buffett actually, that's why Berkshire Hathaway is successful the way it is. Berkshire Hathaway is a ginormous insurance company that can use tax-free money to roll it in and allocate and buy companies. So it's his vehicle to avoid taxes. And that's how they've been able to compound their returns, everything else. But this is common. But what it means, though, is when you take those catastrophic losses, there's something called reinsurance. So you can have reinsurance, which means if your losses are so big at one time, there's another level of reinsurance that insurance companies have. They have to buy reinsurance, and their reinsurance kicks in. Those premiums then go up. So it's this cascading level of losses that hit those insurance companies, and then premiums have to skyrocket to, first of all, not just deal with the losses, the increased population. Every time that building costs go up 10%, the insurance companies have to insure 10% of the whole more because they have to do it for replacement costs. So inflation directly drives how much these people have to insure. So their premiums have to come up to max.
So yeah, so inflation, so the replacement costs, and then like you kind of just breezed over reinsurance. Reinsurance was a huge deal for these insurance companies because the reinsurance, like when the interest rates went up so high, the demand for people to do reinsurance for these large insurance companies plummeted because they could get decent returns just, you could buy corporate bonds at, 8% now. And so why would you take the risk of doing reinsurance at 9 or 10, whatever the going rate is for that, when you could get high bond rates on this? So like the reinsurance costs, it's so like funny because like the insurance companies are like, we're saying like all these insurance companies, they're bending us over, their costs are going so high. Well, the insurance companies have the same thing. They're like, our reinsurance costs are going so high, we're getting bent over in the reinsurance. So it's kind of the same thing.
The insurance that makes money, so the insurance that doesn't take large losses, we don't use insurance companies for. We self-fund that. So we have insurance where it's something like only 20% of the premium dollars will ever be, and we can measure it. It's really known. All the companies and everybody there, we just self-fund it. We do it ourselves so we can make the money. So once premium actually gets to a point where it's reliable, it has a big enough margin, nobody has insurance companies do it. We all self-fund. Why? Because we don't want them to take our premium. So insurance companies are left with, you have reinsurance, you have self-funded, and then here are these levels that they have to pay. They have to keep their float on deck. All their losses, though, that come in, they get hit and wiped out. So It isn't some sham where insurance companies are charging more just because they want to make more money. That their margins are not only not that big, it's being driven due to population. It is being driven to the centralized effect of losses from natural disasters in the most natural disaster prone areas. The United States used to not live in natural disaster prone areas. The smaller percentage of the population lived in harsher climates. That has changed since 1950. That has really changed after the 80s. And after the 90s went in, when we had, so mass adoption of AC happened in the 80s. That revolutionized the South. And over from 2000 on, that concentration, that also moved people into areas like swamps, like Florida, where Jay wants to live, with alligators and big mosquitoes, right? So all of a sudden you have people moving where they would have never lived before. They are also the most prone to these natural disasters. It's a cyclical effect.
Well, it's television's fault, right? So now you have all these TV shows like Swamp People and Gator Boys and all that stuff, and it makes it look like it's cool to live with all the alligators.
Jay wants to be a Gator Boy. That's what Jay stands for, Gator.
A lot of that migration, I mean, at the end of the day, it's this unintended consequences of inflation. I do believe you've mentioned it, you've hit it on the nail, AJ, obviously, but inflation, I think, is one of the biggest factors because it's twofold, right? Number one, inflation, high cost of living has driven people away from, look at my state in California, people are leaving California and going to places they otherwise wouldn't ordinarily do because they can't afford to live in the places they ordinarily live. So they have to stretch themselves and go to places they ordinarily wouldn't have gone. And to your point, the replacement cost, thanks to inflation, has gone through the roof. So if something does burn down from a fire or whatever, the insurance company has to rebuild that. And the cost of labor, the cost of materials, copper, everything that goes into rebuilding a home has skyrocketed. I mean, in California, similar to Florida, but for different reasons, California's had a huge outflow of insurance companies because in California, they can't raise rates to keep up with their costs. And so everybody's starting to flee the state. The latest one that's been in the news here the last couple of weeks is State Farm. And they're demanding, basically saying, look, if we can't raise our rates 30%, we're going to leave the state. We're going to have to leave the state. And if you do the math, it turns out that the inflationary cost of labor, material, and all that stuff is about 30% since the last time they were able to raise the rent. So they're just trying to keep up with the increased cost, that inflation. So it's this ugly head of inflation that a lot of times you don't think of. You think of inflation, oh, prices at the grocery store is going up. It's got all these other unintended consequences, and this is just one of them.
Well, and like you're talking about right there, it's important for everybody to know. Like, yeah, but I built my house at this. Yeah, you built your house for $200,000, but 20 years later, it's worth $1.5 million. The insurance company does not cover what you paid. It has to cover the replacement cost. So all of a sudden, this real estate insurance has to go up with the market, whether you paid for it or not. So now your cost of insurance, people are like, that's as much as my mortgage. Yeah, but that's because you bought it so cheap, right? Where now it's worth so much more. They're covering the 1.5 million, not the 200,000.
I think we'd also be remiss if we didn't mention the fact that since the 1960s, the number of natural disasters has increased tenfold across the world. And so,
but that also is only caused because disaster. So natural, right, is occurrence, but disaster means you actually have to have an effect on people. So really the problem, once again, is it is increasing, but it's increasing because where people live. So when you look in like California, Utah, the encroach on, and the insurance companies actually have big maps they can show you. We know all the zones, fire. The encroach on the highest risk areas was non-existent just 40 years ago. So there was never natural disasters there. Those are just called wildfires. They're not natural disasters. They're just fires. When people move into them, guess what happens? They're disasters now. So we're moving into these areas that we know these burn down every single year. And so what now they're being prohibited by state laws is saying you can't exclude certain areas. So if I'm an insurance company in California, I am now regulated on where I can. I can't just say, yes, right. And health insurance company has all these laws to dictate them. Why? Because people would never get insurance, right? If not, there would be certain areas where they would never get insurance. So the government's like, you can't do that. So as people moved in there, they're actually being forced to insure these people. And it's a compounding effect that just skyrockets these costs for everyone.
Well, before we start getting into a climate change debate, Jay, I want to touch on the question that everyone has here is this a spiraling effect? Like, is this just, are we just going to continue to see these rates go up and up and up? Or was this a temporary thing because, we saw so much inflation and rate hikes all happen at the same time? Like it was kind of a freak thing and they're going to level off? Or, are they going to come back down? Like I guess those are the three options. What do you see happening here?
So I don't think I'm qualified to answer that question. I haven't looked at the data. I do want to mention one thing though. And this has been really big in my area in Southwest Florida, maybe Florida as a whole. But one of the big drivers of insurance costs has been, and they use the term fraud. I'm not sure if fraud's the right term. But in Florida, they've passed a lot of laws recently where they have outlawed, or not outlawed, but they've made it very difficult for contractors basically to go door to door and say, hey, do you mind if I hop up on your roof and see if I can find some roof damage so that we can get your insurance company to pay a claim? And these people are actually just contractors who are looking for business. And so they'll take pictures of the roof and they'll send it to the insurance company. And if the insurance company denies the claim, they'll hire a lawyer. The lawyer will go after the insurance company. And basically there's an entire industry around basically insurance law, where these contractors have these attorneys on retainer, and there are rules that the insurance companies must like go through the courts if they get sued. And so billions of dollars are being spent in Florida based on the fact that there are these contractors that are trying to make a lot of money by defrauding the insurance companies. And so that's part of the reason why some of the things we've seen personally. I own a house that was built in 1998, tile roof. Tile roof should last 40 to 50 years. Basically, in my area, what insurance companies are saying is if you haven't had a new roof put on in the last 10 years, even if you have a 40-year roof, if you haven't had a roof put on in the last 10 years, we're not going to insure you. And then the companies that do insure you say, we're going to depreciate that roof a tremendous amount if you keep it, which means if we ever do have to replace it, you'll get pennies on the dollar to actually replace it. And so just the
carve outs, those are called carve outs. Yeah.
And so just this massive fraud that we've seen in Florida over the last couple of years has really decimated the insurance market. A lot of insurers have moved out and costs have just gone absolutely through the roof. So there's just another factor in play. Kyle?
Same with like the Midwest with hail for the roofs. Yep. That's a big deal. Those guys go door to door and they submit claims because they know how to pay and then they get paid on them. So they go to all the houses because they tell the homeowners it's free to you. Yep. And then the homeowners go, great, replace my roof. And so all of a sudden they're taking in all of these claims and the insurance companies are just getting wiped out by them. And then they're not sure because it wasn't necessarily needed, right? And the qualifications for it was so loosey-goosey that and I think that Florida is leading the way. There has to be more regulation about that because they think it doesn't cost them anything. They're like, yeah, it doesn't cost, but it actually does, because then everybody complains on why insurance is going up. And you're like, you have whole entire neighborhoods where half of the neighborhood's roofs were replaced because one door-to-door sales guy went through and sold every single one of these guys a new roof through their current existing insurance policy because they had a hailstorm a year ago.
And there's a lot of anecdotes. It's funny. It's probably the reason why I've been hearing a lot of anecdotal stories here in California, way that there's the insurance companies are using drones to literally fly over each property. They're literally mapping out all of the insured areas. And originally, some of them are saying it's because they're trying to deny, trying to figure out reasons to deny it. But I think that's one of the reasons it could be as well, just to be able to map out the property. So if somebody does come in and make a claim, they've got some records of what it looked like and be able to map out their territory.
And this is such a huge problem. I mean, Jay, I got a buddy in Florida where you are. He's got a property. His insurance went up so much it took out the profit of his property. The insurance increase. He's like, I'm going to sell it. I have a few friends that are like, we literally won't buy property there because the insurance is so out of control. We don't know what it'll do. That they're looking at it and they're like, it's more
than really tripled in the last 3 years on our commercial properties. Because, like I do the underwriting and it used to be $450 a door and now it's up to like $1,400 plus. And that's not even for flood insurance. That's just for normal insurance. And the problem is, that's for that's for like Texas. But the problem is we go to other states where we're also doing stuff in Georgia, and I'm still seeing increases that crazy. And I'm like, Texas, I get a little bit, like hurricanes pass through there and like there's more weather events. Like I get the increases there, but even other states, like it's like a trickle down effect where these insurance companies, they're losing money. So they just jack up the prices everywhere. And it leads to this spiral effect where somewhere like we keep bringing up Florida, but because Florida is the worst in the country. But somewhere like Florida, or to Mauricio's point with California, insurance companies are just saying, you know what, it's not worth it. I'm out of here. And so when they leave, then that makes the pool of insurance companies that will do there smaller. So what happens? Supply and demand, right?
Damage concentrated, and it just goes up even worse.
Like we had a property that we came up for renewal, and first of all, anybody who has commercial properties, I recommend at least 2 months before renewal. Get the conversation with your insurance broker going, because we had one come up for renewal about a month early, and that company was like, "We're not doing this area. We're out of here. We're not doing it anymore." So we had to go and find one, and same thing. There enough insurance companies had left. We had trouble finding one. We had to do like bridge insurance, which I guess I should have known existed, but I never needed to know that existed, where there's insurance companies that will give you basically bridge loan of insurance, until we had to find another insurance company to pick up a new policy. So it's like, it's getting to the point where it's just so like tumultuous right now. Like it's crazy that like I feel
7 property insurance companies in Florida went out of business, bankrupt. They went bankrupt in Florida. 7.
I feel like it's got to calm down at some point. Like there's no way it's this sustainable, because if it keeps going at this rate, then unfortunately, like the government is going to have to step in. Like you're seeing like, especially certain areas, like we could talk about it as real estate investors, but there's people like homeowners, even like they're losing their homes over this. Like they're having insurance premiums go up 5x in some areas, and like they just can't afford it, so they lose their home. And like I usually hate government intervention, but we might actually, in this case, we might need it. Some regulation. We might need some. To me, what makes the most sense is like giving subsidies or giving like some sort of discounts for weatherproofing materials. Like when you have a hurricane hit your property and you got to rebuild, like let's rebuild it with something that's going to withstand that the next time, and then you get premiums brought down. Or there's even technology there now, like I've seen other operators do it, where you could actually jack up your entire apartment complex by a couple feet to get it out of a flood zone. Like there's stuff out there, but it's such just a churn and burn business that it's kind of just goes on deaf ears.
Well, and to put this in perspective, in California, over 200,000 homes were built in the most extreme fire hazardous areas. These are areas that are known, they just burn down every year. So 200,000 homes were built in areas that they know are they just get wiped out. They're red zones, right? And so it makes you wonder, and I've often thought about this too, the government has to step in on it, but are we going to ensure people that you're building where it's going to just burn down? Like, how are we going to go about this? Because you're right, it's a problem for everybody that we take on. And if you're going to risk your property, which fine by me, I don't care, as long as I don't have to pay for it, right? But it brings into question it used to be, we could just build anywhere, we could do anywhere. Is insurance going to start to dictate, though, building costs, where we build, how we're allowed to build, things like that? I mean, you should almost, it goes, if you are in an area that is red, extreme, hazardous of fire, you probably should have to have totally different rules and everything, especially if it's a communally shared insurance. And as of right now, though, that's not happening and it's not stopping. So people just...
It's going to dictate where people move, though, for sure. Like Mauricio talks about people leaving California, like, oh, they want to get away from the high taxes in California. Well, okay, now we're to the point where we're getting away from the high taxes in California. You're not moving to Florida because you're going from, you're getting shot a different way. Like it's like like people from New York. Okay, yeah. Oh, taxes in New York are so awful. Let's move to Florida in droves. Well, they're moving back now because the extreme heat and the insurance costs are saying like it's not worth it anymore.
So we literally see people moving out of Southwest Florida because they can't afford insurance. Just to put that in perspective, we're selling about 2/3 of our single family properties down here, specifically because insurance costs have gone through the roof and they've gone from cash flow positive to cash flow negative properties based on the insurance costs. Now, some of them have been reclassified into flood zones after recent hurricanes, and the flood insurance is adding to it as well. But even basic dwelling insurance has doubled for most of my properties over the last couple of years. And I mean, to put it into perspective, I have a couple properties that probably worth somewhere between $200,000 and $300,000 that we're paying somewhere between $7,000 and $9,000 per year in insurance. If somebody were to buy that property, I mean, that's literally equivalent to an extra $100,000 in value on that property. Their mortgage payment, if you include the insurance escrow, is basically gone from buying a $250,000 house to buying a $350,000 house. And so, Kyle, you asked a good question earlier, and I didn't have a good answer, but I will say that that in Florida, at least, there is an insurer of last resort. There's a government, I don't know what the relationship is, but government sponsored or government somehow affiliated insurer that if you can't get insurance otherwise, or if your insurance otherwise is too unaffordable, they're forced to insure you. And like you said, AJ, by force, it doesn't matter if you live on an island in the Gulf that's likely to get destroyed if there's a big hurricane. They have to insure you. And it's going to drive up the cost for everybody when those events happen.
Well, and this map here kind of represents a lot of what's going on. And it's a ginormous problem. So if you look at Southern California here, and Mauricio, you can let us know, does anybody live like over here in the Santa Monica Mountains or Malibu? The red areas that you see, these are what's listed as the severity zones that the states are responsible for, meaning these are the just routinely, they burn down, right? It's been a thing. It's always been a thing. But these areas, what is interesting enough that has really happened that you can see, they actually end up being the most expensive, nicest homes. So the total allocation of cost and everything in these massive areas that are covered where we have, I mean, you could go back down to like Florida, everything else, but look at Southern California and you can see these areas.
Basically, for anybody that's listening and not watching, the map that AJ has up is a fire hazard severity zone map. And in Southern California, basically, what's that, 2/3 of the land in Southern California, which is mostly mountains, is bright red.
Yeah, I was going to say that as somebody who lives in that. Yeah, somebody who lives smack in that area. I mean, you've got the ocean, and then you kind of got a little basin, and then what happens, a few miles in is you should start. I mean, that's sort of the Cleveland National Forest. I mean, that's all just government forest land, and it's just mountains and forests, and yeah, it's just nothing but wildlife out there. I mean, that's where I mean,
and if you can't see it, like to paint a visual, these maps kind of look like the current election maps, where they're just mostly red.
But it's a problem that's getting worse. It's not getting better. We continue to build. Costs are going to go up. I don't think anybody thinks that cost of real estate is going to go down. And I don't think there's anybody that thinks that natural disasters are going to go away. They're going to get bigger and worse, and that's going to continue to happen. Fires are going to keep going. It's not going to stop. And we keep funny enough, that when you build in those areas, it's actually costs more to build, right? So if you're building in the hills of California, it costs more than down in the valley floor. So it's a disproportionate problem, right? And the highest risk or the highest cost, and that's where moving into, and then that's where you get the insurance problems. Yet the lower people have to offset those costs, and they are the least ability to afford it. So the people that, like Jay's saying, a single family home, they can't afford it, right? Well, they're getting wiped out, even if their house has never been destroyed. Even if they've never had a problem ever once with their house, their neighborhood's never had a problem, the insurance cost is getting so bad they have to move and they have to leave. And I don't have any answers. It just is what it is. I'm just, it's so people understand where these costs are coming from and what is driving them and why they're not going to not only go away, But insurance is going to keep going up as long as all those other factors do.
Just a quick funny, not a funny, but an interesting anecdote, just because I'm looking into it as well. You know what the cost to build? Forget about the land itself, but just to build the structures on your home back there in Southern California. It's between $600 and $800 a square foot to build. Just forget about the land, excluding the land, just to build a house or a structure on there. You're looking at $600, $700, $800, sometimes $900 a square foot. So just imagine a 1,000 square foot house. You're spending $600-700 grand just on that 1,000 square feet. It's crazy.
That's crazy. Well, I'm hoping that maybe these insurance companies are going to have to get a little bit smarter. I know like it's happened technology wise with stuff like auto insurance. You're seeing some crazy things where like they could track how you drive. They'll give you discounts when you drive a little bit safer. Like maybe something can happen the same way where they're going to start using technology a little bit better and encourage people to be a little bit smarter with where they purchase, how they build, things like that, so we can get these costs down. But hopefully we see inflation tame down. We see a little bit interest rates reprieve, and we'll see insurance rates come down as well a little bit. Anything else? Or can I do a top 10?
Top 10 water parks.
Well, no, I'm going to keep it on the insurance. I'd like to keep the theme going as much as I can with the top 10s, keep it relevant to the discussion. So this is actually an interesting one where it is the top 10 highest premium states for home insurance. So I'm sure you can guess number one, but this study was based off of the average annual cost for homeowners with good credit, no recent claims, and a policy of $300,000 for dwelling coverage. So, and $300,000 of liability coverage. So like a standard.
Is that the $300,000? What does that cover?
Well, so that's what I was looking on here. I'm like, California's not on the list. And then I'm like, the only reason California is not on the list is probably because they couldn't find a house that only needed 300,000, so they just left it off the list because it didn't fit the mold.
I don't think 600 square foot ADUs count.
Okay, so I'll go through the later stages here real quick. Starting at Arkansas, the premiums are $3,300, and then Kansas, Alabama, Nebraska, all in the 3,000 range. Colorado, 4,000. Mississippi, 43. Texas, 4,400. Number 3, Oklahoma, 5,400. Can you guess number 2 state?
I can.
Jay, give it to me.
I would have to assume that it's probably Louisiana.
Louisiana, that jumps up to 6,300. So we've gone from 3,300 number 10 up to 6,300 for the number 2 state. Number 1, anyone want to guess what the cost is for number 1?
I know what it is. All too well.
$10,996. So $11,000. Second place is 6,300. $10,996 for 300,000. That's crazy to me. I couldn't get over that when I saw the numbers on that. How much, like it's almost double the second place. And that's Louisiana. Louisiana, where half the state's underwater. Under sea level.
Would that double then? If I've got if that's for 300 grand, if I wanted to go to 600 grand, would that go to 20, or is there a diminishing as you go higher?
Yeah, it's diminishing because it's unlikely. So most claims are not going to be for the full amount.
Got it.
Yeah.
So there you go. Highest states. So so I wanted to play a quick game with you guys. When I was researching Rick's Cabaret, I came across another fun game that we used to play as kids, and I remembered playing it because I had one of the funniest answers. So the question is, what is your porn star name? And so if you've ever played this is the name of your first pet plus the name of the street you grew up on. And so my first pet was my dear old buddy Gus. Which I thought was a pretty great porn star name. So, Jay, you've had time to think about it now by me saying yours. What is your porn star name?
This is embarrassing. I'm trying to remember the name of the street the name of any of the streets I grew up on. I'm gonna have to come back to you. So my first dog's name was Rookie.
Oh, that's a good one.
But I need to go and figure out what street I grew up on. So come back to me.
AJ, you got one?
Zeke Thornwood.
Yes, that's even better than mine. Mauricio, what do you got?
It's going to probably be like Mickey Frey.
That sounds like a baseball player.
Mickey Frey. Right. But you know, I've grown up in so many different places. It's like, I don't even know where I grew up.
True. Jay, you got one for us?
I'm like sitting here looking to see what the hell street I grew up on.
How do you not remember that? Like, you didn't have a place that you spent like a decade, like during your childhood?
I did. Well, no. So here's something that's crazy. Can I tell you something that's crazy? I literally I counted this. I have lived in 44 different places in my 52 years. How crazy is that?
Well, I've probably beat you, but I went through a few years where
I was at 25 when I was 25. I remember that. And then it slowed down a little bit in the last 25 years, but I'm still.
I grew up on Salem Court. So Rookie Salem.
Rookie Salem. That's not as good as AJ. I think AJ wins this one.
AJ wins that one for sure. Yeah.
You get the first plug then, AJ. What do you got?
You know what? I'm sticking with the book. Go check it out. Growing Wealth and Self-Storage. Number 2. Check it out.
Mauricio, what do you got for us?
I'm going to promote Real Estate Syndicator Live. So if you're a real estate syndicator, every Monday at 11:30 Pacific, I do
not every Monday.
Live. And
I got an email that it was canceled, so it's not every Monday.
Last 2 days ago, since I'm traveling, but next Monday, even though I'm going to be who knows where, I'm going to do one on how to structure your GP entities, which a lot of people have an issue with structuring entities. So I'm going to do a little rant on how to properly structure your GP entities on Monday.
So I assume the purpose of that is you're going to go through how it's all done, and by the end, everyone's going to be like, that was super complicated. I should just hire an attorney to structure my entities for me.
No. I'm the guy who makes complex things easy to understand, Kyle. You know that.
Well, we hire Mauricio to structure our entities. Jay, what do you got?
So tomorrow, I guess the day this comes out, Wednesday, we're going to be starting our underwriting masterclass. So I'm doing an underwriting masterclass. If you want more information, go to jscott.com, and I think it's the top link up there. But you can sign up for our underwriting masterclass. We do charge for it. I've done a lot of free underwriting classes. This one will not be free, but it is 4 weeks of time with Jay to learn underwriting.
Yeah, and there's no better underwriter than Jay.
Kyle says that for people that don't know, he's the lead underwriter in our company, but I can't get him in front of the camera. So
just for the listeners, if you're wondering, this is the only thing I do. I've done 2 other podcasts, I think, in the last 5 years. And AJ, you were one of them, buddy. There you go. All right, I'm going to plug my wife, Badass Investor, at Badass Investor on Insta, Badass Investor on YouTube. Plug our fantasy football league. Let's get an awesome one. Let's make it epic. And yeah, that's all I got. So anything else, guys, or can we sign off for the week?
Let's do it.
All right. Well, my drink has been gone for a little while. Time to go hit the head. So I'll see you next Tuesday.
See ya.